I'm amazed how many people own stocks.
Welcome to the Playing FTSE podcast. My name's Paul, and each episode, me and the lads get together to talk about the stocks, stock market news, and finance in general. Quick disclaimer, you shouldn't consider anything in this podcast as personal financial advice. If you need such advice, go to a financial advisor. And please remember, when investing in any form, your capital is at risk. So sit back, relax, and let the lads fill you in with all the stock market news of the week.
The sucker's going up.
Welcome back, everyone. Welcome back to the Playing FTSE podcast. Today, you've got me, Briscoe, and you've got Stephen, and the other Stephen, Steve D, is off sick today. So we've replaced him with Sven Carlin. That's who we've got today. So in case you didn't know Sven, Sven is probably the biggest value investor on YouTube. I'm pretty sure he'd say that as well. He's also done a Ph.D. I think his Ph.D. thesis was in risk management. This guy knows if there's anything you want to know about investing, this guy knows it. So Sven, welcome today. And where are you coming from today? It looks pretty good where you are.
Thanks for having me. I really appreciate you having me on the podcast. I'm currently in Slovenia, and I'm actually at my kids' daycare because they have a better internet line than I have at home. So I have had to come here so that I can talk to you.
You've probably got a better internet connection than I have, to be honest with you. So that's pretty good. So yeah, today we've managed to get Sven on. So I'm just going to ask him a load of questions because I want to know everything about you, mate, and I want to know where you started investing. In fact, let's just get started. How did you get into investing, and why did you start?
So I was born in the former Socialistic Republic of Yugoslavia, where a stock market didn't even exist. So then we had the war and things like that. And then stocks, and actually a stock exchange, only started somewhere in 1998. And as you had something called privatization, where all the big companies were given to all the population, my parents got some stocks. And as soon as they got the stocks, they sold everything. But I kept following the stock prices, and I saw that if they would have waited 6 months, they would have doubled their money. If they would have waited a year, 2 years, they would have tripled their money. And then I said, wait a minute, there's something with the stock market that there must be something good. And then I started reading some books. I think the first book I got my hands, I was about 15, 16. Despite whatever says about Robert Kiyosaki, the first book, Rich Dad, Poor Dad, was one that I got in my hands. And then there was something about the stock market. He said he bought something for 5 and sold for 15. And I got hooked, and I started researching businesses. But I was immediately not the Kiyosaki gambler or something like that, but I was an owner of businesses. And my dream was to be financially free. I wanted to have $1 million invested, 5-6% growing dividends, and simply be financially free. And that's how I started back in 2001, I think. So I'm 20 years in now.
What was the first stock you bought, Sven?
The first stock I bought was Ericsson Nikola Tesla. It is a Croatian company, but it is owned by Ericsson. It's still owned 49% by Ericsson. And at the moment when I bought it, talking about financial freedom, it was paying a dividend yield of 33%. 3%, not 3.3, 33%. Because everybody was thinking that Ericsson will take it out of the market or something like that, that the Swedish will trick us, poor kids here in Croatia. But I was looking, okay, worst case scenario, they pay me a premium of 30%.
Was Ericsson 33% dividend because you were coming out of the tech bubble at that time in 2001. Was there any reason to do with the tech bubble as to why you started investing at that time?
Ericsson, Nikola Tesla is a tech company because it provides all the things to 2G, 3G, 4G, and now 5G. And they go to all these countries to install all these systems and internet and everything. So it was a tech stock. But when stocks go down, everyone is selling. And 51% of the company was owned by employees. And they were all selling in panic because it's, when stocks go down, everybody's selling no matter the value. And if you can find the value, which I thought 33% dividend yield was value, then you can find your 10x stocks easily.
And I suppose when it's quite heavily employee owned, those investors, because they probably wouldn't be investors as such because they're employee owned, they don't understand it as well as somebody who purposely went out and found the stock, especially
they just everybody got, I think it was 100 stocks for nothing. So it's just something that came, if I sell my stocks now, I can buy a car. And we just exited war, communism. So it was really a lot of money they had. And everybody was selling just to buy something. And then when the stock started to go down because of the dot-com crash, everybody was selling in panic. Let me sell as long as I have something.
Wow, that's a really interesting one. Do you remember at that time? Because this is what I'm trying to find people who were investing at that time, because I'm quite new to investing. I'm one of those new ones. You probably hate me because I'm sort of the new money to the investing and just kind of having a go sort of thing. But I've spoken to some investors who were around then and around 1970s as well. What were the thoughts and what were people saying back then? Because a lot of people were saying back then value is dead and all those sorts of questions and all those sorts of sayings. And is it the same this time? Are you hearing similar things to this? Was there a similar feeling in 2001?
So as when there is a bubble, like everyone discusses stocks, everybody investing, everybody is looking at something. And then when things crash, everyone shuts up. It's absolute silence. I remember in 2007, we had the forum on a local market, and it had about 20,000 daily logins, 20,000. In 2010, it had about 10 daily logins. So when when stocks go up, everyone wants to play the game. Everyone is a genius in a bull market. When stocks crash, nobody wants to talk about stocks. And if you mention stocks, everybody will run away from you. And that's the best time to buy, of course. Now it's everyone is so interested in stocks. Everyone has money, which is really a dangerous place. But then again, if you're an investor, you have to focus on what you own. And don't chase people with, I don't know, buying stocks that will go to Mars or something like that.
Yeah, you know what? I might have even just noticed that. And, you could take a simple measurement on YouTube, and some of those more hypier channels have probably seen quite a decline in their viewership recently, because a lot of those hypier stocks have kind of sold off over the start of the year. That might be something to measure maybe for the future. So with yourself, what is your goal with investing and how far are you from it? And what do you want to achieve with investing?
So when I started investing, my goal was, okay, I want to reach 1 million. I want my dividends and I want to be financially free so that I can go fishing, that I can do whatever I want. And I reached that very early. I think, as I said, a 10-bagger here, 43% dividend. I reached my financial freedom by 2006, let's say. But then I figured out it's a limited financial freedom, because you have to sit tight. That's your funds. You cannot sell anything. You cannot. But then I said, okay, maybe I'm too young to retire. So in 2007, I sold everything. everything, all the stocks. So that was luck, but also my stocks went up 10 times. So I sold everything. And then I bought a boat to enjoy diving. I paid for my PhD. I finished school, I found a job, started learning. Then in 2009, I invested heavily again with everything I had. 2013, sold a lot because we wanted to explore the world, move to England, learn a new language, and see what we are worth. And so it was mostly with stocks up till recently, it was just about exploring possibilities. So never put in the stock market the money you need. So I was always putting the money I didn't need, but when it quadrupled, quintupled, oh, look, I can really increase the quality of my life with stocks. And it has been just the goal. I put it in stocks. If I multiply it, increase the quality of my life, and that's it. And recently, as I am older, have a family, settled down, now I have a few portfolios, and my goal is just to drive them to 1 million, let's say, in 10, 15 years, and I'm on a good path now. So
Sven, having achieved like loads and loads and loads, you described all the stuff that you've kind of done there, and you've written a book as well, and pretty much everything about kind of investing is in that book somewhere or another, and people just need to read that carefully and properly. What keeps you kind of motivated for doing YouTube videos? Because if you're a value investor, right, and you like value investing, you must get a lot of comments about people telling you you're crazy for not buying Bitcoin or Tesla or AMC or whatever, basically. You get the idea. I mean, is it just that you like people telling you that you're an idiot, or something else keeps you going?
When people tell me I'm an idiot, that's a good sign. Then I know I'm doing the right thing. So that's always when I don't get enough idiot comments, then I know I'm in treacherous water. So that's very important to know. As what keeps me motivated, for example, all the money I make from YouTube, it's donated. So we have already refurbished about 5 schools in Nepal after the earthquakes there. We are helping locally with education. So I think I will be like Buffett and will give 99.9% of our wealth away. So I really enjoy researching. I really enjoy looking at businesses and trying to add as much value to people. And the feedback is really nice, both on YouTube, both on other platforms. So I just enjoy what I do, and money is not the first focus, let's say, of the things I do now.
So I see that. That's really amazing. Paul, have you ever thought about refurbishing any Nepalese schools?
I kind of focus on because people ask me about going into a junior ISA and buying stuff for my kids and things. And I kind of focus on the aircraft style, put your own oxygen mask on first. I mean, Sven is like far past that, and I'm nowhere near that at the moment. I'm trying to start off, but yeah, let's work on me, and then maybe my own kids, and then I'll go for the Nepalese school straight after as well.
I would add here, Warren Buffett in a recent interview said that for 70 years he did not have any financial concerns.
Yeah. So
Warren Buffett, he didn't have to think about money, which allowed him to have his mind free. And that's the best way to do rational investing decisions. Mm. So, of course, first put your mask on yourself, and then you will be okay. And then you can start exploring. And I would argue here with you, don't put the mask on your kids. Let them find their own way. Because if you put everything served for them, there would be snowflakes or something like that. So give them an education and give them enough so that they don't have to, that they can do anything, but not too much that they don't have to do anything.
Yeah, it's very well known that second generation and third generation wealth just destroys it, don't they? Because they've been sort of handed it to them. Is there anything you're doing with your kids to teach them? Like, I suppose you're not trying to give them anything, but I imagine you're gonna give them something. It's just a bit of protection maybe. But what are you teaching them? How do you teach them? Is there anything that you can sort of pass on to your kids with investing?
So I have now a kid of 4.5 years, and I have been a high school teacher for 5 years. I have been a university lecturer for 3 years. So I've worked with a lot of kids, and the most important things you can teach them is self-confidence, is how to find solutions to the environment around them, because one day you are not going to be around them to give. And the last thing I want with my kid is to see him as a spoiled brat. So my kid will get an education, will get the knowledge, will get the possibilities, will get the traveling, will try to do as much as possible to expand his horizons, his knowledge, his, let's say, life tool skill set. But as for money, he will not inherit whatever I accumulate in life. It will all be donated to trusts or charities or something. Because I think that if I would, I don't know, tell him, okay, here you have $1 million or a house, or you don't have to do anything in life, I would make a disservice to him.
I do understand that, because I think I sort of, I do think that as well. But on the other hand, I do think maybe I do want to just make life a little bit easier for them as well, because I feel like I feel like I've struggled earlier in life, and certainly never been taught anything, and that's something that's probably there's a lot of anger here about that, especially in the investing community in the UK at the moment, is that we're just not we're not taught anything about this. It's crazy.
Exactly, you're talking about education, not money.
Yeah.
When you have an education, you gave them everything. If you give them money, then they don't need an education because they think they have money, and then they do the wrong things.
Yeah. It's crazy, because it's just, I can't believe that we're not taught this. Is there any different education out there in Europe that's different to the UK, maybe that gets you into money and education?
I think the school systems are simply set up in a way that you are not supposed to be taught financial education. The financial education on life investing education or personal finance is something for the elites. And if you know too much about finance, you will never vote for your government. So, for example,
is that the same everywhere, Sven?
Yes, it's everywhere. For example, especially in the UK, in the US, you have this very separated educational system where the rich kids go to Eton to become prime ministers, and everybody else goes to whatever school they can get. And it's everything is structured in a way that you do your job, you put your head down, you shut up, and you wait for your retirement. But if somebody teaches you that inflation measured by the government is 2%, but if somebody teaches you how that is measured in school, then you would see that it's 5%. And then you would say, wait, you are giving me a pension for 2% inflation, but real inflation is 5%. So you are stealing 80% of my pension when I retire. Imagine if everyone would learn that at school, how would our politicians live? That the government steals 80% of your retirement with inflation.
Yeah, I suppose we shouldn't get too political, but yeah, I totally agree.
No, this is not politics. Yeah. This is everywhere.
Yeah.
This is just how things work, not politics, left, right, or this or that. This is just how things work. You need to keep the people happy, but let's say in a state of ignorance so that they don't ask too many questions.
So is all the buzz on the internet right now with YouTube and many more internet resources for investing, like yourself, like many other YouTubers out there and personal finance YouTubers, Is there a bit of an awakening with investing right now? Because I'm new to investing. I think Stephen's relatively new to investing as well. Do you kind of hate us, like being brand new and trying to sort of stab at it? Or do you welcome it? Do you welcome the new investing wave?
I really welcome it, because at the end, it's about the person. So maybe we are in a bubble now and it will pop in a few years, and 80% of current investors will never touch the stock market. But there will still be 20% that will be left. I received so many emails about Sven. I wish I knew about you in 1996, because I lost everything in the dot-com bubble. Then I lost everything in the housing bubble, and I just started building my portfolio from scratch. If I had you 30 years ago, I would now be a multi-millionaire, because I was doing the wrong things. So that's also a reason why I like sharing what I do, and because if I can help one person, I've done a great job. I know I cannot help everyone, because people are still investing in, not to mention any names.
Yeah, I sometimes do, but yeah, it gets me into trouble every now and then.
I don't know. Let's take, I don't know, Virgin Galactic or something like that. So those are. Then you have to teach people. Okay, that's a specific bet. That's not investing. That's really a big gamble with high risk. And then you can discuss the upside. But I try to discuss the risk and reward, and I try, hopefully, that some people will understand the risk and reward and the outlook for such investments.
I wasn't going to ask you anything really recent, but I'm going to anyway. With Charlie and Warren talking on the sofa with Becky Quick the other day about Robinhood, do you think it's a good idea or a bad idea? You know, Robinhood, the app, and in the UK here, we have Free Trade and Trading 212, which are very similar. They're unlocking all of that new young money, as it were. And there's a lot of betting and stuff going on. What do you think about that?
It's just gambling. It's terrible, because they just think of the business model. The business model is about how to attract as many people to the platform. To attract people, you need to incentivize people with what they want. And what people want, they want fast money. So Robinhood and everything is structured so that people who want fast money, who want those things, get into the things. And you see Robinhood, you need to talk about these stocks that are hot, and nobody explains the investing. And then you said the platforms were called free trading. So you can make money by trading. Nobody talks about investing, because investing, nobody makes any money. Wall Street doesn't make any money on Warren Buffett and Berkshire. So they hate him. But if you go to these new Robinhood stocks that are traded like a zillion times a day, everybody makes money except in the long term, the investor. Yeah. So the only issue is you have to be smart. And of course, if you get free trades, okay, you can take them. But then you have to be smart not to fall under the influence of the likely 3 times a day emails. Oh, you missed this move, you missed this hot stock, this is the hottest stock, trade this, trade that. And if you can avoid being under the influence of that, then it's okay.
Well, to be honest with you, I wasn't sure what answer I was going to get from that, and that's amazing. That's a good enough answer for me, Sven. Okay, a little bit of investment.
I would just add here another very important thing. You have that retirement plan in what's called in the UK. I don't know what, ISA or something like that.
Yeah, ISA. Mm-hmm.
And if a broker, those free brokers are not under that system, then it's really bad, because they incentivize gambling and everything. So that's very important. And if it is like long-term investing for retirement, tax advantages and everything, then it's okay, because then you're starting thinking, okay, I'm doing this for my retirement, not for some gambles. So that's also, I think, a threshold one can think about.
Yeah, that's brilliant. Okay, so we'll get more onto investing if that's okay, because you talked about 80% of the people that are in investments right now, if there is the mother of all crashes, that Michael Burry style mother of all crashes, if it is coming, a lot of people are sort of preparing for it. I've noticed a lot of people in my comments have been saying, like, I'm holding cash because I'm waiting for the crash to happen. But it could be years, right? It could be years for that to happen. When your stocks go down, inevitably, as the whole market goes down, do you ever get worried yourself? Because you've been through a couple of crashes now. Do you ever get worried yourself, and what keeps you, I don't know, holding, and how strong's your stomach, basically? Is it pretty good?
That's a good question. And so I've been last year in March, my portfolio crashed, I think 55%. So that's a significant crash. And what did I do? I was buying like crazy. I even took some leverage that was part of my strategy to buy more. And I simply enjoyed the 50% discounts on anything that I already like. And that's also something that people have to understand from investing. Warren Buffett's Berkshire Hathaway, so the holy grail of investing, every 12 years, it crashes 40 to 50%. And that has been the case statistically over the last 50 years. So approximately every 10 to 15 years, it goes down from top tick to bottom tick 50%. Berkshire Hathaway from Warren Buffett. So you cannot avoid these crashes. You just have to accept it as a given. And then okay, I have 10 years to compound as crazy. When a crash comes, I have to try to find the money and the courage and the stomach to buy more. And that's it.
So, Sven, I mean, Paul was talking about crashes and people being interested in them. I am a pretty avid Sven follower on YouTube. I think you said in one of your videos that any of your videos that have crash in the title get more views than any of your videos that don't. Is that right?
Yes. So, for example, if I put stock market crash ahead, I am immediately at 100,000 to 150,000 views. If I put really interesting small cap investment analysis where I spend days on it, I get 10,000 views and the performance on YouTube is terrible. So if I would be a rich YouTube person if I would make 3 YouTube crash videos a day.
Yeah, no one wants
just
to be...
Just put that one out there for Paul. Yeah.
We'll title this video something like that, maybe. And,
just title the video Sven Kerlin predicts humongous crash ahead. Just title it like that, and it will be your best, and put a thumb with crashing on my face, and you will see it will be your best video ever.
Yeah, we'll avoid Hungarian oil stocks or utility stocks or something like that, and because no one wants to listen to them. Steve, do you have the questions up? Do you want to ask any of these questions that I've got written down?
Shall I pick one up? Yeah. Okay. So, I mean, here's a question about investing that I find really interesting. It's kind of a selfish question for me, but I'm an academic basically by training, and Buffett talks a lot about finding your kind of circle of competence, and I'm not really sure what that is for me in investing terms, because it's really hard to buy a university. I'd be pretty good at analysing a university, I think, as a business. I work in them, I have a decent idea of how they function and so on. But I kind of find it hard to work out kind of what my circle of competence might be. How do you think about yours?
So as an academic university, you have, I think Coursera also has a stock now, or everything has a stock now. Yeah. But when it comes
I don't like that one though.
When it comes to investing, it's about circle of competence. Okay, is this really a good university? Yes. Will students be coming to this university for the next 50 years? Yes. Okay, why don't I look for some real estate? What's the price of the real estate student? And what's the yield there? How can I structure the leverage? And then you start just looking at what you know. university, okay, education is one thing, and it has been exploding recently online and everything. So the more you know about something, then you'll find the niches and how it works and what works best. So, and the more you research as an academic, you do research and you learn, you read and understand things, and then you see how things work. And when you find something low risk and high potential upside, then you invest.
There you go.
So
there you go, Steve.
yeah.
So just get yourself onto the Oxford University Real Estate Investment Trust. I'm guessing there is one, right?
No, the problem with Oxford is that there's so much money that it's all just privately owned and nobody has any intention of selling anything at
Exactly.
all at any price, pretty much.
That's what I figured. That is what I figured.
I mean, it does have a massive moat, both in the business sense and in a literal sense.
So Sven, right? We have quite a young audience watching us, like sort of the 20s, and these guys do want to take bigger risks. Do you think it's better to take those bigger risks when you're younger, particularly investing, but in anything else really, anything else with life? Because I know you took a few risks when you were younger.
So when it comes to investing, one should always avoid risk, because investing is about compounding. And if you're young, you have the biggest investment advantage compared to anyone else, which is time. So Warren Buffett says, you want to be a great investor, start young. So if you're all young, you can start really, really to compound things and start now. And it's incredible what you can do in 20, 30, 50 years. And when it comes to risk, depends how you define risk, because doing something crazy, gambling, is stupid, where the odds are against you. But if you can find things where the odds are really working for you, then it's the time to really hammer down and work on the risk. But you have to always think about risk and reward. That's investing. And that's something that's very, very difficult, because if you are real value investors, first think about what can go wrong and then think about what can go right. And that's a concept that people have a hard time understanding. So that would be the first concept that I would teach such a young audience: risk and reward.
Don't worry, I am still here. My camera's just turned off. So okay, we'll keep it going. No one wants to look at me. It's fine. Okay, so a bit of a harder question, because I find this one really hard to answer myself. But broad-based indexes. Everyone says that we should be just picking, even the buff saying it, that we should just be picking up some ETFs, some broad-based index funds and investing in those and ignoring stocks. Do you ever get tempted to just take that advice and do it yourself? Or I suppose you're already financially free, so you can take a lot more risk and you have a lot more freedom with this. But for someone like myself, would you say buying a broad-based index fund is just where we should be?
No, I think you should think. You should think, okay, if I look at the S&P 500 index, what can I expect as a return? So there is a dividend yield of 2%. Okay, am I happy with 2% per year? There are good businesses, great businesses, best American businesses. There's likely growth ahead of 2-3% alongside inflation. So 2% dividend plus 3%, I'm at a long-term return of 5%. So that's the approach. That's the risk-reward investing approach. What can go wrong? Indexes can always crash 50%. What do I do if it happens? If you're a real investor and say, okay, if indexes crash 50%, I buy more, I keep just setting aside my money over the long term, no matter what, through thick and thin, then you're a great investor. You don't have to spend a minute a day looking at the market. You just automatically invest in index funds, and in 50 years, you will be great. But you also have an option. Now we are at 5%. Okay, if I buy a house with a mortgage, put the down payment, I can maybe get to 10%, because real estate give 4% if I compare my rent. And then it's always about finding opportunities and comparing opportunities. So index funds with the right strategy should be great for the average investor that doesn't want to spend a minute thinking about investing. If you are listening to this podcast 40 minutes in, then you are not that person because you already spent more time that you should spend on investing in stocks in 40 years.
Yeah.
Because index funds, okay, everything is automatic. I don't think about it. I'm happy if it crashes because I can accumulate more. So if you have such a mindset and you're happy with 5 to 7% long term, no matter the ups and downs, then yes. But if you want more, if you want, let's say, less upside, if you start thinking, okay, can I compare, can I find better than 5%? What other options are there? Then I really think I never liked being average in life. So I always strive for better. And if I would have invested 20 years ago, putting my money into index funds, I would be a poor kid still living in a former communist country.
And that's just where I wanted to go.
So,
I just wanted to step it up one extra layer, because if anyone's able to answer this question, it's going to be you, because I struggle to answer it myself. When 98% or 90% of market makers or money managers don't beat the market, what makes it possible for someone else to do it? And obviously you're a believer that you can beat the market. Why should we think we can as well?
So when I started investing 20 years ago, my home country index was at 1,200 points. That was 20 years ago. Today, the index is at 2,000 points. So it didn't even double over 20 years. So that's terrible performance. So if I would have invested in indexes, I would be a terrible investor, because there is the S&P 500 that did remarkably well. But there are other 500 indices that also might not do, will certainly not do as well. So my idea is, I don't care. Stop thinking about the market. Start thinking about what kind of return for the relevant risk is good for you. If somebody would tell me that I can get real returns of 15% per year for the next 10 years, but that the market might do 20% returns, I would sign immediately. I'm happy with 15% real returns over 10 years. That's my target.
Yeah.
If the market does 20, great. I'm happy for all the other richness in the world. Everybody will be richer. Great. But so I really don't know what the market will do. And now we are in a period where the markets did really well for the last 40 years. But we have also seen periods in time when markets did really bad for 25 years. So I prefer to focus on dividends, on what's good for me, what's the return I need to reach my financial goals, not about the market. Who cares about the market? If the market crashes 60% and your portfolio crashes 50%, are you happy?
Well, that's it, isn't it? It's something that I have been through that, because I was investing before the COVID crash. So I went through a bit of it, and my stomach wasn't very strong because I think I was very new at that time. But I stayed. That's very important as well. I wasn't one of the new ones. So it is hard. It's very hard to think. And yeah, I get asked that question a lot. And that's a great answer, to be honest with you. It's good to hear it from somebody who actually knows how to answer that question, which is great.
For me, it's always about what you own, not about the market. I really, really don't care about stock prices, because I know stock prices can go up and down all the time. And I know that there is a statistical chance that all the indices, if interest rates go up, the S&P 500 or the FTSE or everything will be 70% down in 7 years. there is a possibility that that can happen. There you have your crash title and thumbnail. But that can really happen. So one should really think, okay, what can happen and how does that fit me personally? You have your financial goals, you have spouses, you have your kids, you have your plans in life, and then you have to structure things. Okay, how can I structure my financial life so that it gives more value to me? Who cares about what the market in Australia or the market in the US does? You care about your financial life, and you have to reach your financial goals, and you have to find the investments that will lead you there. If your goal is outperforming the market, yes, the market can go down 70%, you can go down 60%, but I don't think you would be happy that you outperform the market. So it's really about what you own, how you own it, why you own it, what do you get from that investment. And to keep talking about Buffett, he says, whatever you should buy it and imagine that the stock market would close for 10 years. Mm-hmm. And that's such an overused quote, but it's so powerful. And actually, no one goes deep enough to think about it. Mm. When you buy something, try to think, okay, am I happy owning this? Really, if tomorrow the government says, okay, we're going to close down the stock market for 10 years because we are pissed off by these Robin Hood traders and everything, would I be happy owning that business for 10 years? And that's a key question to ask yourself before buying anything. And if the answer is yes, I would be happy owning that business for 10 years, then everything becomes so easy. If it goes down, you buy more. If it goes up, well, then you have other problems to deal with.
I love that. That is, if there's any bit of information to take away from this, I think that's a really, really good one, because I don't think people think like that. And if I'm honest with you, I don't think I've ever properly thought like that. I do follow the whole mantra of the whole buying businesses, because I spend way too much time looking at businesses and sort of knowing what I own. And I do my best to think in that way. But I hadn't thought, oh yeah, if I can't trade out of this right now, would I be happy staying in it? Would I be happy just taking the cash flow and stuff like that? And in 10 years, when it came to it, it'd be okay.
That's typical human behavior. So we are wired for the short term. That's because of evolution. Our brains are wired so fight or flee. So really wired to react instinctively and fast and get things immediately. I'm hungry, I need to reward. So that's how we are wired. But that's a terrible wiring for investing. So investing is about long term, about compounding. And if I would take statistical numbers, I think 85% of people will never understand investing. They're always, okay, where will the stock go? This stock will go up. I just spoke to, for charity, I do some individual chats and then people give for charity. I just spoke to a guy and he said he bought Virgin Galactic because when they do a good launch, the stock will go up. And he doubled his money on that. But I told him what would have happened if the rocket exploded. He would have lost all of his money. So that is betting. But real investors think, okay, what happens if I own Virgin Galactic for the next 10 years? They say, okay, I can lose everything, but I can also make big money. So what's the strategy there? Okay, what happens if I own 100 businesses like Virgin Galactic? And then you're already talking about investing, because, okay, of those 100, 90 will go bankrupt, 5 will do nothing, and 5 will be the next Amazons, the next Googles, which will cover for all the losses. That's investing. So it's always about structuring the risk reward. Looking at where the stock price will go is just a waste of time, especially in periods of 3 to 6 months or a year. So as you said, you're wasting too much time on that.
But it's a new paradigm, Sven. This time it's different, right? That's
yes. And it works for you like it will work for the rest of 85% of the population, right? So,
okay.
So the next in 2023, the most mass-produced cars will be Ferraris and Lamborghinis, and I don't know, Ford will go bankrupt because everyone is so rich that nobody will buy a Ford.
Love it. Okay, I've just got a couple more for you, Sven, if that's okay. So we just got one question. It's in bold here, so one of these guys really wanted to ask it.
Yeah, it wasn't me.
Okay, it was Steve D. Steve, if you're watching this, then yeah, we're asking you a question. So you did your Beyond Meat video very recently, and we learned that you were vegetarian. In that, I'm not vegetarian, but the missus is. I go veggie every now and then, but I'm not specifically. I don't specifically avoid meat or anything. Are you vegetarian for animal ESG reasons, or is it just because you don't sort of like meat? I know it's just we're leading to an investment question.
Okay, so since I was a kid, I don't know why I never liked meat, but I come from a meat eating environment where you simply eat 3 times meat. And when I met my missus, then she was a vegetarian and a nutritionist and everything. And she started cooking for us, and I simply never looked back like I would eat meat or something. But I love diving, spearfishing. So tomorrow we go to the sea because I come from the Mediterranean Sea, and tomorrow I go spearfishing. So I try to catch some fish, and we eat the fish that I catch, for example.
Okay. That's fair enough. Yeah, because I was sort of leading you to a question about values and any particular values that you might have. I don't know if you hate oil. You probably don't hate oil. You probably don't hate mining. I was going for the vegetarian angle, really. But would you ever invest in anything that was against your values?
That's a really, really good question, because I try to really, when it comes to investing and doing the job as an investor, then I have to think about risk reward, structuring those things. And I'm simply a numbers guy. I'm autistic to all emotions. I'm unemotional. I'm anything. So when you ask me about values, we can debate about that endlessly. So I really don't think about that that much. I'm just thinking, if people are smart, I have to position myself in a way so that I get advantage of the good things that are going on in the world. So if this is right and this does good, then people will follow, then the investment will do good. So actually it goes hand in hand. If it does wrong to people, if it is a bad investment for the world, for this, for that, then it will not be a good investment. So it goes really hand in hand if you think about it a little bit more long term. If it's not good for the environment, it's unsustainable, people will stop using it. Look at coal, look at cigarettes. So from an investing autistic numerical perspective, I have nothing against investing in cigarettes. But I saw the trends, and then I'm thinking, okay, the trend is negative, better avoid. And you simply follow also the risk and reward. And if a company is not doing good, then also the risk is high, and therefore you don't invest. So it's both ESG and risk and reward value investing go hand in hand.
Yeah, I like that, because there is a bit of a trend going on at the minute where people are trying to invest for the future, for the betterment of humanity, and the stocks that have gone vastly overvalued, or we've seen that exuberance in, are often involved in this narrative, of the narrative of
okay, but that's a narrative. And if you go into narratives, then 95% of every narrative is pure bullshit. So if you just dig deep and you go actually to read things about, if Tesla makes a car, finds lithium in Argentina. They send that lithium to Japan. Then they make the battery. Then they send the battery back to America. Then they make the parts for the car. Then they put the car on a boat. They ship it to the Netherlands. They assemble it, and then they sell it again somewhere else. So if that has anything to do with sustainability or ESG, shoot me.
Oh no,
So,
he said the T word.
so-
We got to ring a bell or something.
so that's okay. If you really go deep and dig into, okay. But if you say, okay, I want to help the world, I have a garden in front of my house. We eat as much vegetables that we can buy from local farmers. So it doesn't have to be produced in the Netherlands, shipped to the store here or something. If you look at your carrots at your local Tesco's, it's likely made in the Netherlands or something like that. Yeah. You can buy it from your local farmer. It's healthier, it's better. You can grow it yourself. And then there are so many ways people can do good, but they don't want to think, oh, I put my 1,000 pounds into that stock and I feel good. That's bullshit in my perspective.
All right. That's excellent. Right. We haven't asked you anything about stocks, and unfortunately, a lot of people will want to know your opinion on certain things. So if it's okay with you, at the end of this, just to finish it off, we want to play a little game. Every week we kind of play a little game with ourselves. It's quite fun. And this week we've developed a game called Sven Carl in or Sven Carl out. So basically we just want to take your very short opinion on certain investment. There's a few stocks in here by the looks of things. Just your opinions on it, and tell us whether you're Sven Carl in or Sven Carl out. I can't believe we're doing it.
All right.
I can't believe we're doing this. This is.
I can't believe we're doing this. All right.
I sort of think I want to say this is beneath us, but it's not beneath us. It's probably beneath Sven, but it's not beneath you and me.
You're too exuberant about investing, and you're also overestimating me. So.
Oh, lovely stuff. Okay, quick fire then, Sven. I'm just in this list because I didn't actually create any on this list. So let's go with it, because this all says SW and SD. So Briscoe hasn't asked any of these. I'll try and figure one out by the end of it. So the first one on their list is Verizon. Sven Carl in or Sven Carl out? What do you think?
I'm in for dividend investors, safety, and for slow and steady, it really good business, strong moat, a little bit risky on the debt side, but yeah.
I should say I bought Verizon about half an hour ago.
Yeah. Oh, did you? Oh,
I did. Yeah.
Full disclosure there, apparently. Okay,
Carlin in.
He's Sven Carl in there. So next one is Disney. Sven Carl in, Sven Carl out.
I made a video about Disney about 2 years ago where I said that the Netflix option was completely not priced in. Now it's priced in, so I think I would call it a little bit more risky, but still good business, still really good, but likely now a little bit more exuberantly priced. Yeah. So let's say if Verizon is in from a value investing, this one, let's say now out.
Yeah, that makes a lot of sense. I think we agree with you. I didn't see that video. I've never actually seen you talk about Disney, so that'd be an interesting one to see. I came to the same conclusion, probably not 2 years ago, but yeah, that's great. So the next one, Sven Carl in, Sven Carl out on Next Era Energy. There's a lot of stocks in this one, Steve.
We get onto other things in a minute.
I didn't dig deep into it, but they constantly issue shares and they constantly finance and they constantly do deals in a very exuberant market, which is too risky because I have seen a lot of these house of cards simply unfold. And I don't know enough to say whether it is a house of cards based on liabilities and leverage or not. So I don't know. But I would look into that if I would be interested into a company like that.
Cool.
Yeah, it's so I'm going to say Sven Carl out on that one because he's risk averse. So that's it.
Yes, definitely. For me,
I
out
understand
on
that.
the risk, because I looked, I saw too risky. Okay, thank you, goodbye.
That makes sense.
One of your previous favorites, I believe, Southern Copper. Southern Copper.
All right, Southern Copper looked like a really good business, but now it all depends on copper. Now I think it has crashed a little bit, but for me, it has to crash a lot more.
Yeah, I we're throwing you a lot of low balls here because this is I already know the answer
No
to some of
problem.
these.
I have the answer. I'll tell you immediately. In the next recession, I'm in.
Yeah, that
So
makes a lot of sense.
In fairness to Steve and me, here's what that's doing on that list. It looks like a low ball, but both Steve and I bought this around the time of Sven's video, sort of a year and a half ago or something like that. And it roughly doubled for us, and then it retreated back to about 60 or so. And we were sort of wondering, okay, we weren't interested in buying it after it had doubled. We were interested in buying it before it doubled. We wondered where Sven sort of felt about it kind of at the moment, because it's quite a way between those
Of
things.
course, when copper stocks doubled or tripled, the risk went up and the return went down. So it's always about balancing that with other options. So for now, let's say it's medium risk, medium reward, which is not the case what it was a year ago when it was absolute dirt cheap, no risk, extreme reward.
Okay, you can't ask for a more in-depth view than that, guys. That's pretty good. Right, so I've got Steve W is asking Sven Carl in, Sven Carl out on Warren Buffett. What was your angle there, Steve?
Well, we sort of touched on it already a little bit here. I mean, Buffett is a big advocate of the idea that people should stop picking stocks and buy the S&P quite a bit. Sven is not a fan of that idea, from what I understand of it.
Buffett is also not a fan of that, but Buffett says, I never told anyone in my life to invest in Berkshire. So he says, if you don't want to spend any minute on investing, then invest in an index fund. But if you want to learn about investing, then you can talk to me. But he knows that when he's speaking on CNBC, he's talking to 99% of the population, where he knows that they would do better to automatically invest in index funds, set it and forget it. Don't think about it, but be sure to especially buy through thick and thin.
So and I do have another angle here on this, actually.
Just on Buffett.
Sorry, go on. Yeah.
Just on Buffett, watch what he does, not what he says.
That's a very popular
thing to say. I think that's a good principle in general, for what it's worth. Yeah. I mean, one thing he's done, at least, or I think I was reading that he's done, is buy back Berkshire Hathaway in the last quarter or so. I think you sold out of Berkshire Hathaway, right?
Yes, I think we bought again a year ago, and then it went up about 60-70%. And it's such a stable company. It's such a good business. It's such really something so stable that it will not grow fast. So I'm just looking for better opportunities. So again, when it was giving a 10% earnings yield, I say it was low risk, good reward for Berkshire. Now it's around 6-7% long term, which is medium risk, medium reward. So still excellent, still great, but I just had a small position, so maybe I'll come back. You never know.
I reckon he's Sven Carl in on Warren Buffett. Over to you.
Yeah, I'd go with Sven Carl in there. Promised you, Sven. We've only got 3 more for you. 3 more, so that you won't be around forever. I'm just giving you some light at the end of the tunnel on this one. We've got the next one is copper. I'm going to tell you that he's Sven Carl out now because I think he believes we're in the top of a copper cycle there. But the next one after that is lithium. Sven, are you Sven Carl in or Sven Carl out?
Sven Carl out, because I've listened 2-3 years ago to Lucas Landin, which is one of the best investors in mining stocks, from copper, Landin mining, from uranium and everything. And he said that lithium is very hard to invest in. So it is great speculative, but from an investing perspective, it's very hard. And I spent a lot of time looking at, and there is so much lithium in the Earth's crust they just need to be incentivized to dig it out, and they can dig it out at 2,000 to 3,000 all over Europe, England. They can dig it out at $2,000, $3,000 per ton. So the current price of 10, 12,000 is really incentivizing them to put on the big mining guns. And when they do that, it's too risky. Speculatively, it was, of course, a great play, but long-term, I think it will even out if it will boom. So that's the complexity of investing in lead. It's complex. That's it. You really, you need to be a speculator to speculate in it. And I prefer investing.
That's very good. Okay, so next one, big tech. Sven Carl in, Sven Carl out. Big tech.
In.
As in to invest
because
in?
They are, yes, because they are building moats. As time passes, the moats are getting bigger and bigger. The cash flows are getting bigger and bigger. They are investing in better and better businesses, servicing everything. So from a business perspective, I'm really, really in.
That's
of
good.
course, I bought Apple in 2016, but that's different.
Oh, a little slide in there. Oh, Sven did really well on Apple, in case anyone didn't know.
I would point out, though, that one of the reasons I'm not interested in Apple at the moment is from watching Sven's videos. I mean, his stuff around buybacks in Apple has really been convincing to me. I would point that out.
It depends on valuation, so it depends also on your expected return. Apple is now, 5 times what it was. So the return is 5 times smaller and the risk is 5 times bigger. So that's something to keep in mind. But the businesses like big tech, Google is a great business, Microsoft is a great business. So, and when you own great businesses, let's say from an average investing perspective, you can't go really wrong. If it goes down, you buy more. If it goes up, you're okay. So
not to
Amazon
mention,
is such a great business. So if
not to mention Baba,
so
which
you
were
can't
quite
go wrong.
interested in recently, Alibaba. You were quite positive on them recently, weren't you?
The risk reward is really pretty positive. So I've made a few scenarios. I think a week, 2 weeks ago, I spent 7-8 days working, wrote a 70-80 page report on them. And the risk reward for investing in them is pretty positive. When you look at what they're doing, how they're doing it, and when you analyze the situation around them, it's mostly sentiment because everyone hates China, of course, you need someone to hate. But what they're doing, businesses, always such businesses will be hated and up and down. But from an investing perspective, few things can go wrong with such companies, Tencent, Alibaba. And
there's one more that I need to ask you, because you're Carl in on big tech, which we weren't sure if you were going to be in or out on it. That's a very good one. But Steve D, who's not here today, wanted to ask you, breaking up big tech. How do you feel about breaking up big tech? Carl in, Carl out?
Irrelevant.
So, I thought you were going to say that. I did think you were going to say that. I guessed in my head, I went, this doesn't matter. It just doesn't matter, does it?
Irrelevant. What if we go back to ESG companies, do you know what every company is doing? Okay, let's just sell our bad assets and we are sustainable. Yeah, and the bad factories and the bad assets are just sold to a new company that is not sustainable, that is selling the product to Africa where they don't care about it, or India. And you just go on. So it's like splitting big tech. Okay, you're going to separate Facebook and Instagram, and then they're just going to make a contract and that's it. Or you want to go back to, or you want to go to communism, and that's a totally different thing. But,
well, that was probably where I was going to go to next for you. Is I know you're talking about, we're talking about from an investment perspective that, breaking up big tech probably doesn't really matter because they'll just all contract out to each other anyway. But I don't like to get too political, but from a humanitarian point of view, what do you think? Do you think big tech's good at the moment? Do you think it's too invasive, or data mining problems, or what do you think?
Depends on the company. For example, Facebook is really playing with your mind. They are really looking how the dopamine reacts, and they are looking at your actions, and they're trying to make you addictive to it. But on the other hand, some other businesses like Amazon, okay, I want this and this book. I'm living in the mountains in Slovenia. I go to Amazon Germany, I click on those books and buy it. And in a few days, I have it at home and I can read those books so that I can make a book review. So nobody is controlling my mind there. So there is good and bad. I think in China, a few years ago, they limited the amount of time a person can be on an app, which I agree, for example.
Yeah.
I think all those gamings, they limited it. They say you can be so many hours and that's it. So I think it's always about, I'm more about individual responsibilities there. So of course, wasting time on Facebook or wasting time about looking YouTube crash videos, that's a waste of time. But who am I to tell you that? Who am I to tell you how you should spend your time?
Speaking of time, how much more time have you got, Sven?
We can go on if you want.
I mean, we haven't really got much more. I was kind of going to end it there, but I'm kind of like intrigued as to just what your day's like. Like, what when you wake up, what does Sven Carlin do in a day? What?
When I wake up, I cook some porridge for us.
Not too much detail.
We eat the porridge. Not too much. Then I bring my kid to daycare, come home, work, research, look at businesses, analyze stocks, look at the earnings reports and that. And at 4 o'clock, daycare is over. So family time.
You're spending a good part of your day, like a 9 to 5 on researching stocks still?
Yes. 8 to 4. I do I don't know, I work from 8 to 10, 11. Then I go for a bike ride for an hour or something like that. And then from 4, it's family time. And then at night, videos or editing or commenting on things like that. So yeah. So I spend my 9 to 5 research and my 8, 9 to 10, 11 talking to guys from the UK.
Yeah, I know. You're not going to rest because you're financially free, and I know you enjoy it that much to do this.
Actually, I think people should first understand what financial freedom is by testing it, and then you get bored the hell out of it.
Yeah.
So okay, it's beautiful to be free. Okay, tomorrow it's Thursday, and at 1 we leave. We go for a long weekend. We relax. I'll be reading some books. I'll be doing this. I'll be doing that. That's nice, but just doing nothing is too boring.
I totally agree. And I think the difference on that there, I mean, you probably don't even remember what it's like to have that monetary pressure on you.
I remember because I sold everything 6-7 years ago to move to England. So I had to find a job, I had to work, I had to everything. But I remember before starting my job in Bloomberg, I would get up at 4 o'clock and write articles and do things to try to get to financial freedom. So
Sven, that was something I was going to touch on earlier, but I just kind of skipped over it. I left it because I thought, you know what, it's not too much to point out. But I think it's really important to point out that you've been financially free, and then you stopped. And you just put it all back into your life, and you've done it twice. You've essentially become financially free twice.
Yes, but always at a higher level. So actually 3 times. So 1, and then I said, okay, this is not enough. Let's reinvest it in myself. 2, reinvest it in myself, and now there is nothing more to reinvest. So now I can reinvest in myself without needing anything. So cool. I don't have any financial concerns anymore, and that's really, really nice. So I can really do whatever I want. So that's good. But I really enjoy what I do, and I don't see myself stopping in the next 50 years. But I have the luxury. For example, now I won't put any videos on YouTube for 2 weeks, for example, because I simply do other things or research, and I don't have to force myself to put a video.
Yeah, that's it. That's crazy. that you've been able to do something that I'm trying my hardest to figure out and do. So, yeah, it's absolutely amazing. I think we'll leave it there. Unless Steve, you've got anything else you wanted to ask Sven?
I've got nothing else on the list, Paul.
No.
It's been really great having Sven, though. It's been tremendous for me.
Yeah, brilliant. It's been. Thank you so much. We've just lost my camera again, but thank you so much.
Thank you for having me. It was really, really nice. I really enjoyed it. So I really like the cuddling out, cuddling in questions. So we can do this anytime you want.
Oh well, that's it. We've got Sven on speed dial now. So there you go. Thank you so much to everyone for listening and watching today on YouTube and our podcasts. You can listen to our podcasts on Google Podcasts, Apple Podcasts, and Spotify and Audible, and also on YouTube, where this video will be. I don't know where it's going to go. It might even go to Sven's channel. We're not sure yet. So you can see us on our Playing FTSE podcast channel, search for Playing FTSE, and you can also see my channel, Paul Briscoe, if you want to check that out on YouTube. Thank you so much, Sven, for coming and having this chat with us. This has been better than I had imagined, if I'm honest. We found out a lot more about you than we do in your videos, and if anything, I'm just happy about that. If this recording doesn't work, then I'll be happy.
Good. Great to hear. Thank you.
Thank you very much, guys, and
Thank you so much.
Leave any comments below in the YouTube video if you wanted to, and we will see you next week. Thank you.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.